Stop losses. We don't use them here at Nanalyze, and we don't think you should either. We're going to explain why today. Now, when I first suggested this, I wasn't expecting to get as many objections to this statement as we did. Several people challenged this as an absolutely terrible idea and then proceeded to query our motivation. So we'll start this out with an introduction. So I spent the first half of my career in software startups and the second half in finance at an officer level. And I produce these videos because they're remarkably effective in producing leads, not because I give two craps about clout. And I'm also the founder of Nanalyze, and the reason that I created this company is to help people become better investors. That's what we do. So what Nanalyze is, we're a research subscription service founded by tenured financial professionals, and we value wealth preservation as much as appreciation, so people find our risk management approach helps them avoid many pitfalls. I think SPACs are a very good example. We initially warned when that particular investment mechanism came about, and we continued to warn. We covered 100 SPACs, and we said to largely avoid all of them except, I think, 2 or 3, and that was spot on. So we show people how to better manage risk, and we also manage our own pool of assets, which contains more than 60 growth and value stocks. Now, what we're not an investment advisory service. We don't give investment advice. We don't recommend stocks. We don't manage other people's money. Our goal is simply to make you a better investor. Now, when it comes to our audience, we have a rapidly growing brand that has thousands of paying subscribers now, and our most common clients are doctors and tech workers. These are very busy people that don't have a lot of time for fluff. We also have a fair number of institutional investors as subscribers too. So we're naturally extremely protective of these people. So we don't run ads on our YouTube channel. We don't like having BSD trader types around. No 10-bagger hero or zero bullshit. No cheerleading. No promoting bad practices to our audience, no crapto, and no time-wasting tool bags. Well, one warning, and these people get a block. That's because we're short on time and resources, and we need to run a very tight ship. So some beliefs we hold. Sleeping well at night is extremely underrated. Most of us have busy lives, and time is limited. So what we believe is that everyone needs to eventually establish their own living methodology that caters to their own tolerance for risk and investing objectives. Now, it's about time in the market, not timing the market. Your portfolio is like a bar of soap. The more you handle it, the smaller it gets. And we think the KISS principle is very important. Keep it simple, stupid. That's so that everybody can access our content. Now, trading in any form is a bad idea. How do we define trading? It's typically by duration. Now, we know there's many Nostradamus types out there for whom this rule doesn't apply, but our goal is to provide the best practices for investing that will benefit the majority of investors. Now, you're not going to get rich finding the next Microsoft, and we know there are, again, people who think they're the exception to this rule, and that's fine. You can see my previous comment on the Nostradamus types. It's very important to understand how difficult it is to create alpha and how reducing risk is a key to growing and preserving wealth. So let's talk about stop losses. I will presume that since you clicked on this video, you understand how they work. And I took this screen from Charles Schwab. It shows 3 types of stop losses. Basically, you're saying if a stock hits this particular price, sell it. Not sell it at that price, but simply trigger the sale. So if a stock falls very rapidly, this may trigger, and you may end up selling your stock for quite a lot less than the price that you thought you were going to get. That's where the stop limit comes into play. You could say, all right, when that triggers, only sell at this price. So potentially, when the market's closed, the stock could go below, and then it would never sell, so it's largely useless. But then you also have a trailing stop where the stop order just follows behind the stock price as it appreciates. And of course, when it falls, it doesn't, the trailing stop doesn't fall, and that allows you to essentially run a stop order against stocks that are running upward. So there are 2 types of stocks we invest in here at Nanalyze. Dividend growth stocks. These are extremely low volatility companies. When they fall, we generally buy more, and we have a lot of time to make decisions because they're quality companies. We also invest in quality tech stocks. These are typically very high volatility firms. This is why we place a very high degree of focus on quality companies, and there are more difficult decisions that need to be made. And when it comes to selling dividend growth stocks, we sell for one reason: if they stop increasing their dividend. That makes life very easy there. You certainly wouldn't use stop orders if that was your strategy for dividend growth stocks. For tech stocks, we sell for a number of reasons. We trim if they become overweight, ideally. That's a good problem to have. We sell then for two reasons. Let's say exit if our thesis changes or if growth stalls. And both of these things don't happen all of a sudden. That's very important to note. Now, when you purchase a stock, there are two approaches you can take. So first, you can try to guess where the bottom is by reading the technical analysis tea leaves, or you can examine the entrails of a pigeon, which is what a Romanian fortune teller does. Now, either method is probably equally as effective for most investors in the long term. The second approach, the one we use, is dollar cost averaging. That's where you buy set amounts of a stock at fixed time intervals to reduce market timing risk. That becomes purely objective, not subjective. So there's the old saying, technical analysis is astrology for men. Now, if it works for you, and we know a lot of people will come around saying it works for them, that's great to hear. It doesn't work for most people, so it's not an investing best practice. And if you don't understand why that doesn't work for most people, then you probably need to read up a little bit more on the principles of finance. And all those people trying to sell you courses, they play on the belief that people have that somehow there's a way out there that they can beat the markets. Unless you're Renaissance, it's probably not going to happen using technical analysis or any sort of trading methods. Now, when it comes to dollar cost averaging, we always want to purchase quality companies at the lowest price possible. When the stock price falls, we want to buy shares, not sell them. So when people purchase a stock and then immediately put a stop loss order in below that price of that stock, essentially they're saying they're not going to buy that stock when it falls. And what some people do is they'll put in stop loss orders to artificially improve their cost basis. This may explain the strong objections we get to stop losses immediately after a purchase. But volatile stocks fall all the time. What you need to do is assess whether that fall is a buying opportunity or a red flag. And guess what? Your stop loss order isn't going to differentiate between the two. When it comes to stop losses for established positions, what finance professionals do is they use performance attribution techniques to explain share price performance. So, for example, causes of dramatic price action for any given stock. You can have broad market movements such as 9/11 events, dot-com hype implosions, and the like. You do not want to exit at the bottom of these events. That's a bad idea. Then you have company-specific events such as earnings calls. These are often temporary setbacks and usually represent buying opportunities. Again, exiting a stock on a drop without assessing what's going on in volatile tech stocks is not a good idea if you're an investor, not a speculator. Then you have category-specific events such as the gene editing world. So this is where you see a group of stocks that are related in gene editing all running at the same time. It doesn't make sense that they should all do that. Usually it's an event in one that drives up the rest. Rising tide lifts all boats. So a trailing stop loss might work well for trimming on upside hype. That's somewhere you could use that. But downside bucket action is often a buying opportunity except for the marks. If you have bad news for one gene editing stock and it brings the rest down, that's usually a buying opportunity for the others because that bad news didn't directly affect the others. Now, when there's volatility on the downside, it's not immediately apparent which of the above is responsible, and your stop loss isn't going to discern between opportunities and threats. So until you can assess the drivers of the price action that you're seeing, you're acting blindly with a stop loss. People say, but not losing money is the most important thing ever. Exactly. Distinguish between paper losses and realized losses. So when you have those stop losses in place, what you're actually doing is realizing your losses and losing money. Now, stop losses for a portfolio. We see people saying, you absolutely have stop losses across everything. Fine. Where are you going to set them? So say you set them 30% below your cost basis, or you even have a trailing 30%. Well, guess what? Those would have been taken out very quickly when there was the COVID panic. that's when stocks, and we're talking about the S&P 500 here, fell 32% very quickly. So your stop losses would have been taken out. And then what are you going to do? You're going to sit there on your hands and then go back to the pigeon entrails and figure out when you're going to get back in? Doesn't work. So what will end up happening is we'll start going up and say, well, I should buy back in. And then before you know it, oh, I should sell. You're not going to sleep very well at night. It's going to become a very painful exercise in a hurry. Well, I'll just increase my stop loss to 40% across all stocks. Well, the dot-com bubble, that wouldn't have worked so well. You would have sold somewhere around the trough. And what's happening here with this sort of approach to always selling when there's bad news is that you're becoming accustomed to selling stocks when they fall, not buying them. You're doing exactly the opposite of what you should be doing. Here you can see the financial sector crisis of 2007 through 2009, how stop losses at 50% across all your stocks would have been a disaster. So the peak to trough there was 56%. So just some questions here. Let's say your stop loss gets triggered for a volatile tech stock, and this is a stock you want to be in, all right? Because guess what? Most downside action is not a black swan event by definition. So when are you getting back in? Are you going back to the technical analysis tea leaves? You're speculating on price. You're not investing in companies, you're investing in stocks. And examples abound of massive drops in quality names. Amazon around the dot-com time dropped from peak to trough 90%. That would have taken out most people's stop losses. Cisco at 80%. NVIDIA, we've been invested in NVIDIA for a very long time. And we've held steady on that, and we've seen people jump in and out, and they generally aren't too happy with the results. Now, if you're investing in quality names, this is very important, you don't sweat the drawdowns. Hell, you might even do something crazy like add shares when a quality stock falls. Don't be fearful when others are being fearful. There's what Buffett said, be greedy when others are being fearful. So the importance of quality, we can't emphasize this enough. Over time, the market is a weighing machine, and in the short term, it's a voting machine. Private equity firms, they're quick to jump on depressed assets. We would have seen this recently with the bear market that we saw, the most recent one, and PE firms jumping in, acquire cybersecurity assets, things like that. This provides a support level for quality companies. Now, if you're going to invest in shit, you probably should use stop losses because you're going to lose your money anyway. Now, everybody has different methods that work for them. So saying that somebody should never use stop losses is the equivalent of saying that somebody should always use them. I think it shows a naive understanding of how wealth gets created. Stop losses work for some people, and that's great. But we believe, based on what we've talked about today, that they encourage speculation on stock price movements and therefore are generally a bad practice with some exceptions. That's because we invest in companies, not stocks. So here's something to ponder. Would you set a stop loss for an S&P 500 ETF? No, you probably wouldn't. That's because it represents a quality asset and the easiest way to accumulate wealth, and this is what most of our paying subscribers are doing, is by investing a percentage of their monthly income into quality assets. This is simply dollar cost averaging, what we described earlier, at a large scale. You do this over a few decades, it's going to lead to wealth, provided you're investing in a diversified pool of quality assets. Now, people who are doing that, they want every black swan event known to man to strike now, today, so they can buy quality assets cheaper, not sell them. So that's the general reasoning behind people who are accumulating wealth shouldn't be using stop losses. So stop losses, I think, are a great tool for people who take on lots of risk. And the riskier the asset, the more appealing a stop loss becomes. Now, we say here stop losses are a risk management tool for people who take on too much risk. We cross that out. That's incorrect. It's people who take on more risk than what we're willing to take on. And that brings me to the topic of just this channel itself. I pulled up this picture. I wanted to see what 20,000 people look like, and this is 20,000 people in a stadium. And it's quite mind-boggling that we have that many people subscribe to this channel. But that brings around a lot of people, a lot of critics, some better than others. So this particular critic here, this was actually on Twitter, I believe, our post here on stop losses. They say absolutely ridiculous advice. Well, That blanket statement captures none of the nuance in our post, which was about describing why you shouldn't set a stop loss immediately after purchasing a stock. And they go on to say a stop loss is put in place because you have no way of knowing what could change that you don't know. So he's talking about Rumsfeld's unknown unknowns. Well, share price movements we've found usually have meaning if you take the time to look for it. And that's why our trade alerts are so popular. So for our paying subscribers, I think we alert on over 100 stocks now. This person goes on to say, fraud, fired CEO, a crash, a fire, anything can happen. Well, this stuff happens all the time. Fraud. You know how many short reports we've had to sit and dissect with a fine-tooth comb to figure out if there was anything substantial behind them when they accused a company of fraud? In some cases, we believe there are maybe some merits to those accusations. In other cases, no. CEOs getting fired. You know how many CEOs are sort of pushed out the door, and you never, for legal reasons, see a company saying they fired a CEO, right? You can read the press release and insinuate things from it, but these things happen quite frequently. Fires in warehouses. Lots of things happen that are really temporary and just noise. This person goes on to say correctly, the number one rule in investing is loss mitigation. Well, you need to distinguish between paper losses and real losses. Now, stop losses, those lock in real losses. And this other person here that challenged us on stop losses had some great points. They say, what exactly are best practices, right? We were debating about stop losses. Well, I'll give you a few. Diversification, asset class allocation, time in the market, not trying to find the next Microsoft, not investing pre-revenues in stories, not investing in micro caps. Research shows the Sharpe ratio is way off there. You're not getting compensated for the risk you're taking. No over-the-counter shit shows stocks. Stay away from crapto, etc., etc. Now, this person also says, well, we're all investing and speculating. It's not clear how to delineate which is which. There's plenty of gray. We see this raised quite a bit. We'd argue the difference between speculating and investing is duration, and our horizon for both types of stocks is measured in decades. They then say, well, you might be a very successful investor. It doesn't mean everybody will have your success if they follow you blindly. Agree. 95% of professional investors can't beat a benchmark. We get most excited when we see people adopt best practices with variations to match their own unique situation. And they conclude by saying, I'm sure you have at least accepted that there isn't one way to invest. Well, having your own methodology is always better than using someone else's methodology, provided you aren't incorporating bad practices. Always promote the methods and practices that benefit the most investors. There's tons of man bites dog stories out there, but that's not what people need to be concerned with. So, I'm going to go ahead and wrap this up and leave you with this other piece that we did on trading and why that's a bad idea for retail investors. We're going to put a link to our newsletter in the comment section. Please make sure to sign up for that. Like this video. Let us know what you think about stop losses in the comment section. Thanks so much for taking the time to watch this today.